So, have you ever thought, are those in finance just guessing with my money? Well, maybe they are, but there really is more to it. In this video, I'm going to be explaining the science behind investing. So first, a random walk and the capital asset pricing model. So to explain where we are now, I have to explain where we started. Originally, we thought stock movements were just random, bouncing around, not really telling us anything. You could argue that it was French mathematician Louis Bachelier who started it. His 1900 PhD thesis, The Theory of Speculation, Bachelier demonstrated that security prices move in such a random fashion that the mathematical expectation of a speculator is zero. It's basically just saying that the past performance a stock's experienced has no bearing on the future, so it's impossible to speculate and gain from it. We kind of moved on from there, and the next main stop was the capital asset pricing model put forward by Jack Trainer in 1961. The CAPM, as it's called, is a model which says investors expect to be compensated for the time value of money and the risk they're taking. Asset pricing models have evolved over time, and as more independent risks have been identified, these independent risks are commonly known as factors. Any discussion on factor investing has to start with market beta, the original factor. No, not that factor. This is taking us all the way back to the 1960s. At that time, the primary asset model was the capital asset pricing model, as I've mentioned, and what the CAPM looks at is the measure of sensitivity between an asset or portfolio and the risk of the overall market. This measure of this is what's called market beta, which you might have heard of. Okay, how this works is imagine you had a market cap weighted equity index fund, and that would have a market beta of 1, as it represents the market. A portfolio of half the equity index fund and the rest in cash would have a beta of 0.5, as it would move up and down at roughly half the rate of the market. So an increase in the market of 10% would expect that portfolio to go up 5%. The idea is, if you had a security which has a beta of 1.5, it means it is more risky than the market. Therefore, you would expect a higher return. So the higher return is not necessarily a good thing here, depending on your aims, because you're taking more risk. So to explain how this all works together, I need to go over the efficient market hypothesis. And this brings on to the next theory, which you have to really believe in to follow any asset pricing model that I've talked about. And this is probably one of the more difficult theories to get your head around. Asset pricing models generally depend on the efficient market hypothesis, as explained by Nobel Prize winner Eugene Fama in 1970. So what an efficient market is that asset prices reflect available information. It doesn't mean it tells us what will happen in the future. It's saying that what we know right now of a security's future return is baked into the price.
And we just buy stocks we think are...
Well, the consensus is built into the price.
And how this is expected to happen is basically due to competition, low trading costs, and readily available information. So say there is a stock which is undervalued. We would expect investors to then buy that stock, which would increase its price, reducing the value and bringing the price back into equilibrium. So I want to address first how unintuitive and potentially uncomfortable that idea may be. Firstly, none of us like to feel like there's some sort of weird controlling force in the market, which is more right than we'll ever be. Sort of kind of like that big lottery finger from finance saying you should have sold last week. Oops. But that isn't really the theory. It's that things are super competitive. The real money, and that's not putting 50 quid into an ISA, the big money, institutional money, which is dealt with by incredibly well-informed, well-qualified investors who, through a mixture of high-frequency trading, have access to information and news flow at an extremely competitive level. Maybe you might be thinking, well, how does the efficient market explain this guy?
See, I feel like I'm financially inside of you or something.
Okay.
I'm jacked.
I'm jacked to the...
Good.
Do you feel it?
No.
Well, that is also kind of the thing. It has all the opinions of the market. You, institutional investors, your Uncle Bob, who has a bunker installed, Karen, who lost her pension details in 1978 and has been outperforming her peers ever since. It's the accumulation of all those opinions which creates the price. But when maybe faced and you sat there thinking, no, that can't be right, or maybe my valuations are better than that. If you are making individual stock picks, I would invite you to follow this link. This is a small part of an outdated bit of institutional level report. Clearly not a recommendation to do anything, but just an insight into the level of competition. For quite a few big companies, you can see parts of the levels of research involved. And if you follow this link, you can have a look. Watch my video why it's so hard to beat the market. The rational view of market pricing is that expected returns relate to risk. There is a risk framework, as the more risky a security is, the higher return an investor would expect. So the risk is reflected in the price. So the problem was this single factor model wasn't a particularly great model. At this time, market beta was the only way we could compare two portfolios. If two portfolios had different returns but the same beta, we'd be like, well, this is the skill of the manager. So the difference in returns would be attributed to their security selection, or maybe timing the market, or perhaps even some undefined reason. Anyway, along came a guy called Rolf Barnes. This isn't Rolf Barnes, this is Rolf Barnes, but I just like to say Rolf Barnes. Anyway, in 1981, he did the paper, The Relationship Between Return and Market Value of Common Stocks. And it said that small stocks were generating alpha. Another paper came along in 1985 called Persuasive Evidence of Market Inefficiency, where they effectively said, look, your model's not that good. And they provided further evidence that market beta didn't tell the full story. In fact, it only really explained about 2/3 of the return, which is actually a bit rubbish. You know, imagine if a scientist told you, my model tells you 2/3 of the reason it blew up. You'd be like, that's weirdly scientific about how bad the model is. So before I move on to the next section, I'll just say, if you enjoyed any of this, please follow my blog. I'm actually not successful enough yet to hyperlink into the description because the YouTube overlords don't want me to, but if you sign up on this link, it's an email a week with videos and articles every so often. I've also started an Instagram account, which again is in the bottom. So let's talk about the joint hypothesis problem. And this is that there are two hypotheses that have to hold true for a model of market efficiency to work. One, the market has to be efficient, as in prices have to reflect available information. And two is the capital asset pricing model and its developments have to also be the correct way to price assets. This means that you can't actually say anything about market efficiency by itself. You can only really say it about the coupling of market efficiency and some security pricing model. The problem here is that it's really hard to unpick where an inaccuracy may lie. The market may reflect available information, but the CAPM may be a poor model of how investors set prices. There may be other risk factors that we haven't fully discovered, or conversely, the CAPM might be precisely how investors are trying to set prices, but they may be failing to do so because of behavioral biases or errors. The fact that we can't unpick these two elements is called the joint hypothesis problem. And that's without the criticism of opening the third option, which is just saying they could actually both be wrong. It's really important to say that when we're talking about financial models, a model is not a law like gravity is, which is kind of absolute. A model is the best version of us explaining the world. This isn't just blind guesses. They have to be robustly tested across time, geographies, and markets. As Fama says.
Fama, if you say that prices reflect all available information, it necessarily means that a price is right at any particular point in time?
That's the statement of the hypothesis, but it's a model. It's not completely true. No models are completely true. They're approximations to the world. The question is, for what purposes are they a good approximation? As far as I'm concerned, they're a good approximation from almost every purpose. I don't know any investors who shouldn't behave as if markets are efficient.
So are markets actually efficient? Models aren't reality. They are a model to explain reality. So the first thing to understand in relation to market efficiency is that prices are always wrong. Always. Being right on a security's price would require one thing you cannot gather ahead of time, which is hindsight. Though the relative question is the cumulative guess of the market and what's baked into the price more right than you're ever going to be? So let's go on to multi-factor models. So what is a factor? Well, a factor is something which has been proven to have an influence on a security's return. These are independent risk factors which explain why different types of securities exhibit different returns. This isn't guesswork. The general agreed tests of the factors, for it to be valid, has to be persistent. It has to show consistently over time and over different geographical regions. It can't just disappear for 1 year. Pervasive. It has to hold across countries, regions, sectors, and even asset classes. It has to be robust. It has to hold for different definitions. So for example, the value premium, whether that was measured by price to book or earnings, cash flow or sales. It has to be intuitive. There has to be logical, risk-based or behavioral explanations. It's not Friday beers factor. And investable. It has to be a factor which we can invest into. Otherwise, what's the point? So I talked about market beta in the capital asset pricing model. That's factor 1. The problem is, since academic finance loves to put forward new stuff, it's created a bit of a factor zoo of lots of debatable factors. Because of this, I'm going to focus on the ones which are the most recognized based on the academic data. So if we talk about market beta on its own as factor 1, we'll enter the 3-factor model in 1992 from French and Fama, sort of the Sonny and Cher of academic finance. Anyway, this used factors of market beta, as we've explained, value. This is also described as high minus low. And you might be thinking, well, why would better value stocks perform better? Well, again, it's going back to market efficiency. Why are they cheaper? They have a higher cost of capital because the market pricing thinks they're riskier. Maybe they're in an unloved sector or face structural headwinds. Value sounds good as a title, but it isn't a free lunch. And then size factor. This is that small cap stocks appear to have a statistically significant higher return for risk-based reasons. Smaller stocks will have a higher failure rate and therefore would be expected to have a higher cost of capital. So French and Fama conducted studies to test their model and that found that when size and value factors were combined with beta, they could explain as much as 95% of the return differences in 2 diversified stock portfolios. But this isn't where it stopped. They tweaked this further to include 2 more factors that were backed up by the data. One was profitability, that the new model added the concept that companies reporting higher future earnings have a higher expected return in the stock market, and then investment, which relates to the concept of internal investment and returns, suggesting that companies directing profit towards major growth projects are more likely to experience losses in the stock market. So this then becomes the 5-factor model as per French and Fama. It does miss off one of the big ones, which is momentum, which, for example, Cliff Asness of AQR supports, which, as the name suggests, securities that have performance momentum tend to continue that trend. And finally, what the evidence isn't. The thing is, these models are not perfect, and even knowing these things doesn't necessarily equip you for the life of a successful investor. There is strong evidence for factor outperformance, but that does not mean you can just take the factors and think it's easy to self-build a portfolio. For example, the value factor I mentioned previously, that underperformed the market generally since about 2007. So that's almost 15 years underperformance to deal with. It's important to say that running these strategies can also be very tricky in relation to implementation compared to what you see in the academic literature. These implementation details matter. So there is still genuine debate and also skill on defining what the right signals are, even if you do want to pursue an underlying risk factor. In the upcoming video, I'm going to be putting together a bit more of a critique and debating if markets are actually rational. There are lots and lots more I could talk about here, including a breakdown of the factors in more detail and more of the evidence. Was this useful, or was it just way too technical? If you can let me know in the comments, then I might go into them in more detail. So if there's anything else left to say, it's thanks very much for watching, and Rolf Barnes.